Welcome to RenMac Off Script. We openly discuss markets, economics, policy, history, and life. It's the 10th of November, 2023. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our RenMac LinkedIn page as well. If you're listening, but you're not an institutional client, but keeping up with the markets is something that's important to you, you can also visit us at RenMac Access. That's renmacaccess.com. It's a site that we designed to give RIAs and intelligent, sophisticated investors some of the insights to the ideas and the topics that we're discussing here. Again, that's renmacaccess.com. Steve, I'm going to give you the floor. We had a debate this week. We had election results. Clearly, abortion is on the minds of the electorate, and seemed to be an overwhelming topic in terms of not only getting people out to vote, but actually expressing their views. Does that really put Republicans in a bind for the remainder of this year?
Let's try to move sequentially, as you allude to, a lot of big election news. So Tuesday, again, was an encouraging night for Democrats, disappointing night for Republicans, although I think the results were mostly expected. I think the margin of victory for Democrats was bigger than anticipated. And that's important because the fact that Democrats are able to overperform expectations despite Biden's low approval ratings, despite voters telling pollsters that they're going to prioritize the issue of the economy, which they give Biden poor marks for handling, it makes sense that Democrats are looking for something to energize voters, and they appear to have it with this issue of abortion access. If you want to try to put some sort of positive spin on this for Republicans looking at 24, maybe you hope that with Trump's appeal, assuming he is the nominee, which we'll get to, looking likely, that they sort of flip the script. It used to be Republicans that would usually benefit in these off-year and midterm elections from the smaller electorate. Now there's some belief that they might actually benefit more in the general election because of Trump's appeal to these low propensity voters to come out. We'll see if that bears out. We also don't know with Biden at the top of the ticket. You have a lot of, again, polls showing voter concern with Biden, not only over his handling of the economy, but concerns over his cognitive ability. In 22 and 23, he hasn't been at the top of the ticket. If he is, I think those Democrats that want to get rid of him will point to that as the reason why, that the Democrat brand necessarily isn't the problem, that it's a Biden specific problem. But the fact that they did overperform in 23, I think makes it less likely that he's going to feel pressure to step aside. So fast forward to Wednesday, another debate. This time, I don't know if we call it the Fab Five, but you had 5 participants on the stage for the Republicans, a little smaller, a little more substantive. I think what we've seen now is in the polls and the fundraising and even the debate performances that Florida Governor Ron DeSantis, former UN ambassador, former South Carolina Governor Nikki Haley are really differentiating themselves. It was an interesting start. It was focused more on foreign policy with former Vice President Mike Pence out of the race. Haley's sort of the only one really that's in there with any foreign policy. It's interesting in the sense that her positions are more the traditional interventionist approach, which is at odds with a lot of the base of the party, or the isolationist wings. At the end of the day, I think foreign policy is still a relatively low priority for voters. That'll change if we have a domestic attack here. But really, it's just a question now of who's going to get out. I don't see any traction for Chris Christie, who was pretty much ideologically very aligned with Nikki Haley. If he wants to help her, maybe he gets out before New Hampshire. And then Tim Scott, whether he's trying to stay in to hurt DeSantis, they're both really campaigning hard there in Iowa to maybe hope a backdoor, that if he does that, Trump will reward him with a VP slot. I don't know. Ramaswamy seems to be on a kamikaze mission to destroy Haley. I think it may be backfiring because I think his personal attacks may be helping her rather than hurting her. But again, we'll see how long he wants to stay into the race. And then we get to some of the announcements we saw yesterday, Thursday, which may be a little underreported, but could be significant when we get to the general election. You have Joe Manchin saying that he won't run again for re-election in the Senate, which isn't surprising because he was going to lose. But he did sort of tease, because Manchin is always the perpetual tease here in Washington, this potential third-party presidential run. If he does that, he could pull a lot of votes for Biden. Maybe underreported was Jill Stein running as the Green Party candidate. She has access to all the ballots. A lot of Democrats blaming her for costing Hillary the election in 2016. We talk about a close elections, margins matter. So I think there was a lot going on, and hopefully I did sort of the Chris Berman version of covering it in a short amount of time.
Nikki Haley is definitely a likable candidate, but can she win the I mean, it doesn't look like anybody's going to be able to win the nomination, right? Given what's going on, but it's
Why is that the assumption? I mean, I understand that that's the conventional wisdom, but you're talking about basically an incumbent president. I mean, he's an incumbent. Trump has the best name recognition of any of the candidates on that stage, and he's under 50 in both Iowa and New Hampshire. Right? I mean, that's pretty weak. That's pretty weak. I mean, come on.
That's what DeSantis mentioned that after the debate when asked at NBC, and it's true. I mean, an ordinary incumbent, if that's your standard, you would expect to at least be close to the 80s.
He should be walking away with it. I mean, unless he wants to call up Robert Cahaly and have another push poll to make DeSantis look weaker than he actually is. I mean, we all know that's what's going on. It's pathetic. I mean, so I don't know. I mean, I just feel like we'll see what happens at the caucus, and whoever. I mean, DeSantis did get what's her face's nomination,
Kim Reynolds, the governor. That was to sort of stop the slide there after Haley came out ahead in the polls. Haley has an interesting decision to make strategically. Is she going to be more aggressive now to try to win Iowa and get some of the momentum? And if she tries to do positions there that are going to appeal to Iowa voters, is that going to hurt her standing in New Hampshire? Again, if Christie were able to get out, maybe that would be less of a risk for her. At the end of the day, though, Jeff, to your point, I think she's running a very smart general election strategy. I just don't know if that's going to help her in the Republican primary. And at some point, when you look at, I think a lot of Haley supporters, if it came down to a consolidation and two-person race between DeSantis and Trump, I think most of them would gravitate towards DeSantis, just sort of this animosity towards Trump. However, if the situation is reversed and it's sort of Trump versus Haley, I'm not sure all the DeSantis supporters are going to go to Haley, just because most of his policy positions are similar to Trump. So if he gets at least a split there, he being Trump, my guess is he probably have enough to pull away from it, but we'll see.
Yeah, interesting. Banana land. Well, when we look at the markets from a seasonal perspective, particularly around election years, I think it's interesting because you end up with historically a pretty flat market for the first half of the year. It's basically up until about Labor Day. Traditionally, seasonality for the equity markets, you have a little bit of a pause in February, and then a pretty good first half of the year, all things considered. That's not the case historically in election years. You tend to be flattish, and I think that'll end up playing into the markets this year, just because we are obviously seeing trend deterioration. But as we get into what we think will be an overbought condition towards the end of the year, that'll set up most likely for more of a consolidation and a trading range as we get into the first half. That'll be breadth dependent, obviously, as we go, but there's really been nothing that we've seen so far that has shifted our view that we're going to get to the top of that range, which is 4,500. And probably struggle from that point, and hopefully hold the support levels about 40-50, and then trade within that range until eventually we're hopeful that we break up. We're going to have to see yields come down for that to happen. Neil, speaking of yields come down, we did have an auction this week. I think it was yesterday actually, and it was a bit of a nail biter for as Treasury auctions go. I know that's a very exciting event for the general population. Are the bond vigilantes starting to matter now? Is that what we're starting to see here?
I mean, maybe they did this week for a minute. I don't know. Remember that one of the reasons why yields fell in the first place was because there wasn't as much Treasury issuance as expected because revenues came in stronger, and so the government didn't have to issue as much debt. And this week is a reminder that maybe supply still matters because the demand at the auction for the 30-year wasn't particularly strong. So I think the bigger story is that yields have come down pretty notably since their recent highs. We were sort of pushing 5%, and now we're closer to 4.5 on the 10-year. So I think that's the bigger story, and we'll see how that goes. I mean, as you know, we do think that the last employment report is going to raise a lot of eyebrows at the Fed, and the fact that unemployment has ticked up. And look, I don't think it's a very unusual situation because this was a very unusual recession and recovery, right? And you've seen bullwhip dynamics in manufacturing, bullwhip dynamics in housing rents, as an example, and now you're seeing bullwhip dynamics potentially in the labor markets. But it's a very unusual situation in the sense that the big waterfall moments and sort of economic cycles is when you have the unemployment rate rising even as the labor force is contracting. That's not what's going on right now. The unemployment rate has ticked up, and generally speaking, the labor participation rate's going up. So, it's in some respects, it's a supply-driven phenomenon. That being said, I mean, at the end of the day, if wage growth is moderating as a result of that, then there's less rationale for the Fed to stay aggressive, and that opens up the door for them to think about surgical kind of rate cuts. If you go back to the 95-96 experience, where the Fed basically, and remember in 1994, the Fed hiked very aggressively, and then they took some of it back. You could be setting yourself up for something like that next year, where the Fed's basically making sort of incremental changes to policy at the margins. And I don't believe that we're going into a recession. And if that's the case, that's probably all they can get away with doing. But I do think they have plenty of ammunition to sort of make the case that they're able to do that. The unemployment rate now is higher than they had projected for the year. That's the first time that's happened since March of 2022. That's going to give them increased confidence in the inflation outlook, as I mentioned. I mean, the fact that average hourly earnings, as an example, are running barely 3% and underlying productivity growth is maybe around 1%, that's basically achieving their inflation objective, over the medium to longer run. And, I think that sort of lets them kind of, talk about cuts. And if you think about like sort of a standard Taylor rule for framework, I mean, I know that Powell isn't the biggest fan of sort of rules-based policy, but when you think about a standard Taylor rule, I mean, you're basically right there. So if you get a little bit more of a slowing in inflation, I think they can sort of talk about cuts.
Yeah, I was in Boston this week and talking to clients, and I think one of the themes that would come out, or at least a more persistent question, kind of losing control, right? Has the Fed lost, or frankly, the Treasury, have they lost the ability because of the deficits and the debt to really get into a situation where rates can go down, or is this spending just kind of the doomsday machine, and they're not going to be able to get a handle on that? I would say there's a couple things. One is that 5-year forward inflation expectations still are relatively anchored. They're right around 2.25%, which is good news. So they haven't lost credibility there. You would expect, if in fact that was a big problem, or that was the problem, that those inflation expectations would start to rise as there's this monetization of the debt, i.e., printing money to pay for the to pay off your debts. What's your sense on that? I know that's certainly pulling on a string that's a philosophical bearish argument, but and a little bit conspiracy. But there's some point at which the debts matter and the deficits matter. But what's your sense on how close we might be, or the sensitivity of that?
Well, I mean, I think there's nothing really the Fed can do about that. I mean, other than make the problem worse. I mean, the popular argument that I get in some of the meetings is, well, how can the Fed keep raising rates if the deficit's so high they're just exacerbating the issue? Well, that's not their problem. I mean, their problem is employment and inflation, and in that situation, inflation would be getting out of control. I mean, to the extent that the Fed could be cutting, I mean, that should take some pressure off of longer term interest rates, you would think, because long rates are basically expectations of future short rates, right? So you'd see some rally in the longer end if the Fed was cutting. But again, I mean, how far can you really push that with all these other considerations? When I think, I mean, it's very difficult to kind of predict the kind of, what's effectively sort of a black swan moment. You could call it a Liz Truss moment in the U.S. fixed income market, right? I mean, remember, this was the former UK Prime Minister. She came out, she put forward a budget and spending tax plan, and the markets basically said you can't do that. And within a few weeks, essentially the financial markets tossed her out, and we now have Rishi Sunak as the prime minister. That's harder to do here in the States, obviously, given the dynamics of the political system. But it does, I think about what happens after the election, right? I mean, you're going to have potentially a new government or a reelected president or something. I mean, And typically, if recent experience holds, you will have a unified government in 2025, right? And that unified government is going to want to do something to show people, hey, we're trying to help you. Like you're not going to come out and say, hey, we're going to claw back your entitlements or we're going to raise taxes. You usually do something along the lines of spend more, tax less, right? And so the question is, what happens when they try to do that? And how does the market take that? So I think that to me is the more sort of interesting setup. I mean, how much can the after the election, how much can they get away with?
Well, it will be interesting because historically the year after the election is pretty good for equity markets. So to your point, there's kind of this party in power starts to spend some money. Steve, you don't think that's the case?
I'm just questioning whether there's going to be unified government. I think if you look at the forecast and just sort of where the maps are right now, I think right now you have a Democrat-controlled Senate and a Republican-controlled House. I think you could see the inverse after the elections. You have a very favorable map for Republicans that got more favorable after Manchin officially got out yesterday. So I think win, lose, or draw in the presidential, they're probably going to win control of the Senate. And in the House, Republicans would have a narrow 9-seat majority. You have probably 5 seats alone that have been flipped, which is enough to give Democrats control now because of Supreme Court rulings. And you have 18 Republicans defending districts that Biden won compared to only 5 that are Democrats defending districts that Trump won. So I don't know that we will see a unified government, but a lot can the time to tell. But I guess the implications of that is, is there going to be the political will to make some of those difficult decisions? One could argue that the best outcome for that political will would be sort of a re-election of Biden with the Republican Senate, where both sides sort of share the political cost moving forward. That Biden wouldn't be held politically accountable at that point. But we'll see.
It'll look like a nursing home. What do you think the probabilities are that the July rate hike was the last one of this cycle?
I think it's climbing, rising. I mean, I certainly don't think they're going in December, and I don't think they're hiking anytime in the next 6 months.
Do you think it's over 50%? Where are you?
Yeah, at this point, yes. I mean, I think
70.
Yeah, I mean, I think it's my base case.
The price is right, Neil. This is the price is right. Don't go over.
I said it's my base case. I mean, like when you think about these sort of I mean, all of this is sort of contingent on data. And as I've been saying, there's not much value in forecasting right now, unfortunately, because, it's sort of kind of in the fog of war, I guess. But I think, maybe there's some chance that, market participants are kind of overweighting the last employment report. So we come back in December. I think November will be a solid number, right? I mean, there was a lot of strike and other activity that kind of weighed on the October jobs number that will go away. I mean, we know that the UAW came to an agreement. We know that the writers strike, that they came to an agreement. So that should sort of show up at the November jobs number. But, again, I mean, at the end of the day, the unemployment rate is up 0.5 point from its low. And that doesn't necessarily mean recession, but it just means you need to be on guard. And so I think for the Fed, they probably want to get out in front. They're probably in that frame of mind. If you think about what Powell said at his press conference last week, he talked about, he didn't really talk up the prospect of the hike that was in the September dots. He talked about how the dot plot decays in efficacy. He talked about how potential growth might be temporarily elevated. I mean, all of these things raise the bar to do more. Yeah, I mean, I think we're going to go into the new year at a minimum with the Fed having not done anything for 3 consecutive meetings. And, remember, there is still some upward momentum, I think, in the global economy. I mean, in the sense that, foreign central banks have started to cut rates. I mean, that should provide some tailwind for global activity. It does look like we're still seeing some inventory restocking in the U.S. If you look at, consumer spending, I mean, we can talk about this in a little bit, but, gas prices are down. I mean, that should help consumption. So, Yeah, but I generally think the fact that the labor markets have loosened doesn't really create the pressure anymore for the Fed to keep going. You've lost that as a rationale to stay hawkish.
Right. And you actually have floated the balloon of the potential for a negative CPI print, correct?
Yeah, I mean, I think. Well, I mean, we get this data next week, but
Right.
there's a lot of moving parts with the inflation data. I do think it's. I mean, the consensus right now is 0.1, so you can't. I mean, obviously, you can't rule out a donut. But we know that gasoline prices have declined sharply over the month, and that should result in weaker energy. There's going to be a weird thing with medical care insurance, so that can kind of pressure the headline up, right? It's just, I mean, I don't. It's a weird like sort of thing that the government does, but medical care insurance is probably going to be higher in October, and that will provide an offset, obviously. And we also have used car prices that'll probably keep coming down. So I mean, there's a lot of like moving parts in this inflation number, but generally speaking, that's going to matter. Like the medical care thing is going to matter a lot more for CPI than it's not going to really matter for PCE. And so, I do think inflation will be lower.
Yeah. Well, it's going to be important because we've got clearly the sensitivity of equities to the bond yields. We caught bond bears offsides a couple of weeks ago. They were really, kind of piling on. We saw ETF flows to the outflows in the banks. We saw ETF outflows in home builders. We had bond bulls at about 23%. That's historically a low number. By itself, it doesn't mean much, but when you get that spark, it provides the fuel to move things. Dollar bulls were also in the high, call it mid 70s, 73-ish in terms of bulls in the dollar. And what that really means is that they thought that rates were going to continue to go higher at the expense of foreign central banks, right? So that interest rate differential would climb, and that strengthens the currency. So, people were caught offside. So this decline that we've seen has had a little bit of convexity to it, that the outcome was better than not as we go. So I don't think the markets are dependent between now and the end of the year for yields to go lower. I think they need to be stable. I certainly don't think they can go back up to, say, 480. I think that would be a problem for the equity markets. But if we're stable to lower, and we do have support at 435, I continue to believe that the seasonal trends will be favorable and work for the bulls, not the bears. But we'll see. I asked you about the last Fed rate hike because we did a lot of work on the last Fed rate hikes going back to the 1950s. And it's kind of interesting the path right now of industry sectors, factors, styles, whatever. If you look at all of those, over the last 70 years, the path that if we presume that July was the last Fed rate hike, the path that we're most similar to is 1959. In other words, how these things in the market, all these variables are acting similar to today. The highest correlation actually is 1959. Now, you can drive a truck through those numbers usually, so I don't want to get too wed to those things, but they're always good to look at as potential templates for where we are. 1959 was obviously an election year, the year before an election, and the markets basically stagnated, went into a big range, and then started to break out after the election was over, with obviously JFK winning that year, and then we had the Cuban Missile Crisis a couple years later. But it was a big consolidation that ended up breaking out. I don't know if that's how we'll play this, but certainly if we look at seasonality, if we look at an overbought condition going into the end of the year, that could make a lot of sense. That is a similar path to where we are today. So we'll see. Neil, what's on the docket next week?
Well, we get the CPI data as we discussed, and then retail sales, which should also be. I would think retail sales come in a little bit lighter, certainly on the headline, because gas prices fell so much, and this is a nominal data point. We've also seen some slowing in the weekly credit card data, so that should be a headwind as well. But remember, we're coming off a very, very strong quarter for consumer spending. So,
yep. Steve, DC.
So earlier in the week, banking regulators are going to go before the House and Senate, I believe, where you have Michael Barr pushing for increased bank capital requirements. You could get some pushback from Democrats because banks may say, look, it's going to be harder for us to make lending to a lot of these green energy investments. So I think that'll be interesting to see just in the political context. Later in the week, the other thing to watch will be in San Francisco. Biden's supposed to have this meeting with Xi Jinping from China, being reported that they might try to announce some sort of resumption in military to military talks. I think that's just good for the world. If that's the case, we'll see if anything else comes of that. And then whether or not we're going to shut down the government on November 17th. Right now, there doesn't appear to be a plan. There are attempts that maybe the Senate will try to jam the House with this White House request. I think Republicans will only go along with that if they make some traction here on increasing policies to address the southern border. Don't know that they're going to get there. And then the House may just pass more of a clean CR with Israel aid and try to jam the Senate. All this increases the odds of some brinksmanship. So stay tuned for that.
We will. So the S&P resistance 4,500, 4050 is support. Big level 4.35 on the 10-year yield. That's going to prove important. Also the 2-year yield, because if the 2-year yield breaks, it does historically imply that the market says the Fed made a policy mistake. That number would be 4.70. If we break below that, that becomes more problematic for the equity markets. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. And if you want some deeper insights, join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
We'll see you.